Johnson & Johnson, a healthcare giant, but lately J&J stock has been taking a beat. Is this a buying opportunity at these low prices or is something seriously wrong? In this video we'll dive deep into the recent performance of J&J. We'll uncover the reasons behind this dramatic downturn and most importantly we'll analyze the fundamentals and valuation to determine if J&J is a bargain or a ticking time bomb. Don't miss out on this crucial analysis. So let's get started. Johnson & Johnson is a name synonymous with healthcare, but what exactly does this global giant do? J&J is a diversified healthcare company operating across three major segments. First, consumer health. Think iconic brands like Band-Aid, Tylenol, Listerine. These over-the-counter products dominate the global consumer healthcare market. Then in second place, pharmaceuticals. J&J develops and markets innovative drugs across various therapeutic areas, from oncology and immunology to neuroscience. Blockbuster drugs like Stelara and Darzalex drive significant revenues. And in third place, medical devices. From surgical equipment and orthopedic implants to contact lenses and vision care. J&J is a leader in providing cutting-edge medical technologies. But what makes J&J stand out? A strong brand equity, decades of trust and brand recognition across its diverse product portfolio. Research and development powerhouse, J&J consistently invests heavily in R&D, fueling a pipeline of innovative new products. Their global reach, a truly global company with a strong presence in both developed and emerging markets. And at the end, diversified revenue streams, reduces reliance on any single product or market, providing a great stability. This diversified business model and strong competitive advantage have positioned J&J as a dominant player in the global healthcare landscape. We already know that Johnson & Johnson is a pretty solid company, but what are their fundamentals? Right now it's a $352 billion company, which is a huge company. Their forward P it's almost 14, which is pretty low when you look into a price to earnings ratio, for example. They have pretty good margins in my opinion, gross margins of almost 69%, net margins of 16%, but their free cash flow margins are even higher, 24%, 25, 21. 2023 it was 21%, which was lower, but overall they have a pretty solid free cash flow around between 17 to 20 billion dollars per year, which is around a forward P or a forward price to free cash flow ratio around 15, and at first glance it is a pretty low forward P for a company with the quality of Johnson & Johnson, with great margins. Balance sheet, they have $20 billion, but long-term debt of 31, which is a net debt of $11 billion, which they could pay with around 6-7 months of their free cash flow, which is a pretty solid balance sheet. Bear in mind, it's a healthcare company. They have plenty of R&D and capex investment, so they need a lot of money to invest in factories and their capex. So this is a pretty good balance sheet for a company like Johnson & Johnson. Their returns has been really good, return on equity 20%, and they are paying a dividend of around 3%, which is not bad, especially when you compare to the S&P 500 dividend. Year to date, the stock is down 7%, and when you look to the 5-year graph of Johnson stock, the stock has been nowhere for the last 5 years. Right now it's trading around $150, below that. But looking at our manager journey checklist, it's a company with all check marks. Bear in mind, they have been growing, revenue growth of around 1%. I do believe this is really low growth, below inflation actually, which is not the best, or we always like to see companies growing faster. Johnson & Johnson is not doing that, and probably doing some acquisitions during the last few years. But overall, it's growing, which is not bad, and they have pretty solid free cash flow. Margins, really great, low debt, returns on equity and on investment, really high. plenty of competitive advantage, as we have talked in the beginning of the video. So they have a wide moat, they have free cash flow positive, and they are returning capital to the shareholders. They are paying a dividend of 3%, and bear in mind, 2024 they bought back 5% of the company. They are doing a huge buyback during the last year, and 2023 they bought back almost 4% of the company. This is something that are attracting me a lot. This is a sign of confidence from management that they are saying the company is cheap right now, so they are buying back and using their free cash flow to buying back their shares. Of course, this is a very mature company. There are not plenty of reinvestment opportunity, which we would prefer, but at least they are buying back shares of the company at a cheaper valuation. When you look to the graph, revenues steadily growing, but not growing by much. Gross margin very stable, which is very good. Free cash flow around 20 billion, between 17 and 20 billion. Shares outstanding going down, which we always like to see. So in terms of fundamentals, the only problem I see with Johnson & Johnson is their growth. They are a very big company and very mature, so it's difficult to grow a company with this size. But even a company that is not growing, there are value to look into it. So that's why we'll do our discounted cash flow. So for our discounted cash flow, since it's a US company, for me it's a very safe company, like almost a bond. So my discount rate for this company will be around 9.8%. So for my base case, I will use a discount rate of around 9.8%, which is close to the 10%. When you look to the average of the market, 9%, this looks like that's no margin of safety on there. But for a company like Johnson & Johnson, there are plenty of margin of safety, and it is very difficult to find a company with these qualities at a lower discount rate. My assumption for Johnson & Johnson in terms of margins for my base case around 25%. The mean of the last few years has been around 24%, so I do believe they can have free cash flow margin around 25%. In terms of growth, I'm expecting them to be a slow grower. It is expected them to grow around 4% this year and 3% next year, so I will expect growth around 4 and 3%. For a PE, I have to do a premium, even though they are not growing a lot, but the rest of the companies are pretty safe and great quality overall, so I will assume a PE of 20. So with that assumptions, we came with an intrinsic value of $143. So this is my fair value, or a price that I'm interested to buy JNJ. At the moment, there are plenty of healthcare stocks that looks like great opportunities, and JNJ is another stock that looks really great and maybe at a fair valuation. So if the stock can go even cheaper, of course it can, but we don't know the future, and sometimes it is very difficult to find great companies like JNJ at a big discount. So for me, in my opinion, it's trading around my fair value and it's a justified price. So, is JNJ stock a perfect buying opportunity or a dangerous trap? Ultimately, the decision rests with you. While recent challenges have weighed on JNJ, its strong fundamentals, diversified business, and long-term growth prospects remain compelling. However, it's crucial to conduct thorough due diligence and consider your own investment risk tolerance. Stay informed, stay updated, and make informed investment decisions. Thank you for watching. Please like, subscribe, and leave a comment below your thoughts on JNJ stock.